Welcome to my Markets Demystified series. This is episode 3, bonds. Today we're going to talk about the bond market, what bonds are, how they work. The bond market, in essence, is an over the counter market traded much like stocks. People get in and out of bonds all the time. Bonds are different in the fact that, in the aspect of investing, you purchase a bond as a bond investor and you hold on to it for whatever the length of time, and you get interest along the way in addition to a final interest payment at the end, which is called the yield to maturity. Prices and yields fluctuate on a daily basis. They are inversely correlated, which means as the price goes up, the yield goes down, or as the price goes down, the yield goes up. Bonds typically give you a source of steady income versus growth compared to stocks that are more growth orientated. They move faster in price. Bonds are just steady and stable. The nice thing about bonds is they're a consistent, steady source of income, and they're backed by the good faith, and protection of the issuer. Could be the federal government. It could be municipalities. It could also be companies that issue bonds to raise debt, to invest in their equipment, people, more in the company, or in the case of a municipality, to raise funds to upgrade parks and roads and things like that. Schools also issue bonds for expansion projects, more classrooms, upgraded equipment, etc., etc. And bonds are quite an interesting vehicle because they do fluctuate like stocks do. Not as much on a daily basis in price and yield, but you do have a lot of protection when it comes to dissolution of a company. Bondholders are second behind creditors when it comes to dissolution of a company. Okay, and there are also several tax advantages to owning bonds. If you own a municipal bond, for example, it is exempt from federal tax, income tax. If you own a government bond, it is exempt. Your income is exempt from state tax. So that's one arsenal you may choose to have in your investing basket. And I suggest everybody at least have a portion of income or equity income in their portfolio, because even though the market these days is going gangbusters and we're breaking out new highs and doing all these things, you still get to a stage where you want to do capital preservation, not capital appreciation anymore. And having that little bit of protection in your investment portfolio can help you achieve your goal as well. I personally, as a person who has been involved in these markets for the past 20 years or so, um, I rarely looked at bonds until my parents were of retirement age and looked to preserve their capital investments for retirement and these things. Yes, in some cases, the disadvantages are you may lose some upside point wise in your portfolio. But personally, I'd rather tell somebody I'd rather have you keep what you got than risk losing what you have. Because volatility in the markets is absolutely nuts, especially now with the interest rate, potential interest rate increases coming up, soon. Bonds might be a little more of an attractive environment now as yields start to climb. I mean, the 10-year bond was at 1.4 at the low, and it's now at 2.4. So you gained 100 basis points from the low to now. 100 basis points in a nutshell is 1%. So 1 basis point is 0.01% of a move in interest rate. That's how we discuss it. It's talked about basis points. I'm sorry. Then you also look at par value. Par value is the face value that's placed on a bond. So par value is where the yield is that they want to give you the interest rate. So let's say 30-year bond came out at 100, which is usually the par value for the bonds. Okay, yield to maturity 6%. So let's say it goes down to, I don't know, 90. Well, the yield to maturity will climb up to, let's say, round numbers. I don't know the exact correlation as of yet. It changes. Let's say it goes up to 7%. So you gained 1% in interest, although the price dropped $10 from par. As I say, par minus 10. Bonds used to be a very big safe haven. And it's interesting that now more people are choosing to go into equities because they're rallying and, oh my God, it's going up. But don't overlook it. Don't overlook it. You can protect your portfolio that way. You can protect your retirement that way. Is anything in life guaranteed? No. Absolutely not. But it gives you a little bit of protection. That's for sure. More so than stocks do. Bonds are also, ways, as like I said, they're second behind creditors. Well, you're raising debt. How are bonds, companies and municipalities and governments rated? 2 companies, Standard & Poor's and Moody's. Also, I think Fitch is in the game as well. They have a AAA rating, which is top credit, just like we have credit scores, FICO scores. Same thing. The lower the score, the higher the interest has to be paid. You can pay attention, the federal government got their credit rating dropped 1 point, went from AAA to AA, AAA to AA, I think it went, or it went to AAA minus, which is just 1 notch below because these credit agencies thought, it might be a little hard to make obligations. But look at bonds. Look at municipal bonds. They're attractive because you don't get federal income tax done. Something to think about. Obviously, that can change with this new administration. So it's important to talk to your accountant or tax advisor and to see what can work best for your advantage to preserve your capital as best as you can. Well, this is just a light tutorial on them, what they are, how they work, what are they there for. I hope you found it useful. I please encourage you to like, share, and subscribe to this series. I want you to learn from me as much as I want to learn from you. And also, I want to close this video. Also say to please, support me on Patreon as I'm just starting out. And, need some help to get better production, but I just want to spread my knowledge to everybody. And I hope, you can learn something from this. But if I ever say something in error, I encourage you to please let me know, because I'm not perfect. I'll make mistakes. And I also want to encourage you to please live your dream. Because you know what? You might not get there right now at the moment, but if you persevere and fight and find a way to work around it, these obstacles, you can achieve your dream. This is my dream, is teaching you guys, lecturing out there, spreading my knowledge to everybody. I want to give something back. Thanks for listening. I appreciate it. I'll see you next week in this series. Bye-bye.